Masood Ahmed, Director of the Middle East and Central Asia Department. Welcome.
Thank you.
Tell me, how do you see the outlook for the Middle East and North Africa?
The Middle East and North Africa region has been hit by two big shocks over the last year. First, the halving of oil prices, which has had a big impact particularly on the oil exporting countries in the region. And secondly, by the intensification and spread of conflicts in the region. Now, despite both these shocks, the Middle East is still managing to show a modest economic recovery. The oil exporting countries this year are going to do about the same in terms of growth, about 2.5% as last year. And that's mainly because they have been able to use the savings, the financial savings that they accumulated over a whole decade to be able to offset the impact of lower oil prices on their growth. For the oil importing countries in the region, after a few difficult years, you begin to see the combination of a better international environment. Europe is now doing a little bit better. Oil prices are a bit lower for them, but also the payoff from the reforms that they have undertaken over the last few years. So their economic growth rate this year is going to be around 4%, which is a bit higher than last year. However, I should say that neither in the oil exporting countries nor in the oil importing countries is the level of economic growth enough to deal with the chronic problem of unemployment, particularly for young people.
Give me examples of how low oil prices are affecting the oil exporting countries and the low importing countries.
Well, for the oil exporting countries, the first impact of lower oil prices has been on their balance of payments and on their budgets. Just to give you an example, if you look today at the countries that are oil exporters and look at how much they're getting in terms of export earnings from oil, they're projected to get about $380 billion less in export earnings than we had been expecting a year ago. So a big impact for them. Today also the price at which they can break even in terms of their budgets, which is to say the oil price at which their spending equals their income, is now higher than the actual price of oil in all of the countries except Kuwait and Qatar. Those are the only two countries that are continuing to run a budget surplus. What that means is that these countries, even though they have the resources to be able to offset the impact of lower oil prices, will need progressively but in a determined way to try to consolidate their spending over time and also to accelerate the efforts that they have been making to diversify their economies away from relying so much on oil and towards other kinds of industries and services that will provide income and jobs.
How have the several conflicts that are taking place in the region affecting the economies of the region and neighboring countries?
The impact of conflicts in the region is first and foremost a humanitarian cost, which is borne by the people living in the areas that are affected by conflict. But there is also an economic consequence for the countries themselves, for countries like Syria, like Iraq, Yemen now, Libya. You see economic activity being impacted directly, but also on their neighbors. And if you look, for example, at the impact of Syria and Iraq in terms of refugee flows to their neighbors, Jordan and Lebanon are two countries that are hosting, generously hosting, between them over 2 million people from Syria and Iraq. And this has a cost on their budgets, but it also has a cost on education, on the facilities they provide for services to local communities, to the labor market. So there is a spillover cost to their neighboring countries. And what is clear is that this cost cannot be borne just by these countries alone. They will need greater support from the international community, and the IMF has been asking and calling for this greater support to help these countries meet the additional costs.
Masood Ahmed, Director of the Middle East and Central Asia Department, thank you very much.
Thank you.